Ladies and gentlemen, traders and investors, a very warm welcome to our channel Vega. On today's video, we shall talk about options, which we also talked about in our last video. But on our last video, we just tried to define options in simplistic terms. We talked about the rights of the buyers of a call and put option and the obligations of the sellers of call and put options. We also try to talk about European as well as American options, and now we shall try to touch upon the Black and Scholes formula, which is a statistical as well as a mathematical derivation, and it's a sacrosanct formula which nobody in the trading world tries to mess with, or nobody tries to ignore the Greeks contained in the formula. We shall try to explain these Greeks today in as simple and as unsophisticated terms as possible. But before we go on to talk about options, we shall touch upon the indexes, a bit of gold, energies, and of course the US dollar. We may also touch upon a few currencies if time permits, and then we shall come down to talk about options, typically the Greeks that influence the options trade, and then we shall also talk about the price and profit and loss curve that defines the profitability of an option. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the first of a series of interactive videos aimed at educating our viewers, and we would like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market, and we do not advise/recommend/guide anyone to take any trade based on the contents of this video. We do not take any responsibility for total or partial losses arising out of trades based on the contents of this video. Traders and investors, the chart that we see in front of us is that of Dixie, or the US dollar index, and we're looking at the daily chart. We've been visiting this chart for the last couple of weeks, and this particular index has been range bound since April 2025 and is continuing to do so. The lower boundary of the range is 95.459, while the upper boundary is 100.391. But in the last 1 week, there's barely been any move in this particular index, with the index printing red as well as green dojis and staying in the area, or hovering in the area around 98.0. As investors, the chart that we see in front of us is that of Nasdaq, or the NQ, and we're looking at the daily chart. As we can see, the Nasdaq is once again made a new high, and particularly on Friday it had an explosive move touching 29381.84 as the all-time high reached by Nasdaq. Since the index has been very bullish, the only trade that we should try to get into are going to be longs, and the candles forming the demand zones on the daily time frame are quite big, so we must look at opportunities on the lower time frames, which could be the 240-minute chart or the 60-minute chart. On the 240-minute chart, there is a level that we can see here, which is showing an entry at about 28800, with the stop loss going below 28500. That's the first level, and it's got another level right below this one where the entry is at 28500 and the stop loss shall go below 28286, which is right on top of our daily demand zone. But since the index is very bullish, we must find the first opportunity that we can get into and try to hang on to the trade for as long as we can. On the 1 hour chart, there is a nice opportunity at about 28913 with the stop loss going below 28700. So that's the first and the best opportunity for us to go long on Nasdaq. Traders and investors, the chart that we see in front of us is that of the S&P 500 based ETF, which is called ES, and we're looking at the daily chart. Over and above Nasdaq, the S&P 500 and Nikkei 225 of Japan have been the only indexes which have made new highs after the announcement of the ceasefire between US and Iran. But as we can see on the daily chart, the ES has not been as strong as the Nasdaq, although it has made a new high last week and it managed to print a nice green candle on Friday. But the candles are not as explosive as Nasdaq, and we could try to go into a long on this index as well, provided that the leading index Nasdaq is in a nice strong uptrend. Looking at the 240-minute chart, we can try to establish levels where we can enter into a long. On this particular chart, we do not see any nice area, demand area immediately below the high that we have reached. So we would like to go into the 60-minute chart and then look at our level, which is a nice demand level here, where the entry would be at about 7360 and the stop loss could go below 7340, or to be on the safer side, we could go below 7330 as a stop loss. So the entry at 7360 and the stop loss below 7330 is the level at which we can enter into a long trade on the S&P 500. We should try and hang on to our long trade for as far as practicable, because the trend could be strong until there is a violation of the ceasefire between US and Iran. Traders and investors, the chart that we're looking at is XAU/USD, which is the gold-based ETF, and we're looking at the daily chart. Since the announcement of the ceasefire between US and Iran, the movement in this particular asset class has now been very explosive, and the candles have been kind of ballistic candles or lesser explosive candles alternated by dojis. Also, the asset class has not been able to make any lower high during the last 2 to 3 weeks. Its last high that was made was at 4887, and from then on it managed to come down to the area of 4500, and it flirted with this area between 4500 and 4600 for the last 1 week, and then during this week it managed to make a nice drop based rally followed by a rally based rally. But the candles on Thursday and Friday were dojis, and we still need to see a nice rally coming out on Monday or Tuesday in order to see the beginning of an uptrend, if at all the ceasefire continues, or if things go bad, then we could see a rally based drop which could allow it to continue or break below its last low and form a new low to continue with the downtrend. Traders and investors, the chart that we see in front of us is the FXAG/USD, which is the silver based ETF, and we're looking at the daily chart. The only reason that we're visiting this chart this week is because of the bullish candles printed by silver being stronger than those printed on the gold chart, except for the first reddish candle that was printed on Monday. The rest of the candles have been blue, and the candles printed on Wednesday and Friday have been quite explosive, and we still need to see if it manages to print another one or two blue candles to come out of the range bound trade that has been during the past few weeks. We need to see a nice rally based rally in this particular asset class to try and go into a long at the level of 77.90, but before entering into this trade with a stop loss below 76.5, we must see it break above 82 or close above 82 or 83, and then revisit our zone, the demand zone between 78.22 and 76.82. It's a nice rally based rally demand zone, and if we wish to see it on a lower time frame, then the entry would happen at about 77.7, and the stop loss would go below 75.5 because of the wick that we can see extending all the way up to 75.6. So this is the demand zone from where we could get into a long on this particular trade. Traders and investors, the chart that we see in front of us is the US oil spot, and we're looking at the daily chart. This is one of the energy assets which has been directly under the influence of the US-Iran war, and every singular news has had an effect on the movement of the price of this particular asset class. Ever since the announcement of Project Freedom by the United States of America, this particular energy asset managed to hit its recent high, which is at 107.13, and then later on with the President of the United States declaring that he would like to stop with Project Freedom, the energy asset has gone down and has managed to touch the area of 86.9 or 87, but it closed at about 91 on Friday, and we still expect a lot of volatility in this particular asset class. Therefore, traders need to be very careful and should only try to enter into a trade and get out of a trade at the soonest before the announcement of any war related news. Traders and investors, the chart that we see in front of us is that of GBP/USD or cable, and we're looking at the daily chart. Cable has been one of the strongest currencies against the dollar during the last few weeks, and in spite of a lot of local political news, GBP has managed to keep its strength going, and it has managed to stay in an uptrend. Although the trades that we can see in the last couple of weeks have been kind of sideways formations, and the lower boundary of the sideways formation is about 1.345, while the upper boundary is about 1.365. So one can still try to continue taking longs rather than taking shorts on the GBP/USD, and the idea would be to enter at the lower boundary of the range, which is at about 1.345. The entry could be about 1.347 or 348, with a stop loss going below 1.344, and one could ride this trade all the way up to 1.365. That's the trade that we can have on cable, but one needs to be careful on the opening of the cable on Sunday night or Monday morning, which is going to be the first opening after the announcement of the results of the local elections, and that could have a reverse effect on the pair, and this could also provide us with an opportunity to enter into a long trade that we've just discussed. Traders and investors, as we spoke in our last video, the basic function of an option is to allow a trader or an investor to lock the price of the underlying asset at a future date, and this particular asset is called the underlying asset. And since we're talking about a price that is going to be fixed in future, we must need to pay for the uncertainty and the opportunity cost that locks the price of the underlying asset at the strike price. Thus, the option premium or the price of the option is very much dependent upon the changes in the price of the underlying asset, and this particular change of the option price with change of the underlying asset price is known as delta, or it is the first derivative of the change in option price with respect to the change in the underlying price. We then come to the second Greek, which is called theta. Theta defines the rate of change of the option price with change in time. Therefore, there is a very important element with respect to time in the price of an option, and if we look at the curve earlier time in the same video, or maybe on one of our other videos following this one, we shall see the relationship between time and price, and the way the price of an option decays with time. So theta defines, or theta is a first derivative with respect to time. We then come to gamma. Gamma is nothing but the change in the option price with respect to the rate of change of option price. So that's the second derivative of the change of option price with respect to the underlying. We then come to one of the most important elements of factors that influences the price of an option, and that is Vega. Vega is the first derivative of the option price with respect to volatility. Since the option price is very much influenced with the ongoing or the persistent volatility in the market, one needs to be very careful while trading options and must be guided by the existing or the implied volatility in the market. And the last one of all the Greeks is rho, or the dependence of the option price on the interest rate existing in the current market. There is a very weak relationship, not a very strong one, with respect to interest rates, and this is called the first derivative with respect to the change in interest rates in the market. Since the interest rates do not change very frequently and also influence the inflation and the pricing of the underlying asset, therefore, the option price as well is dependent upon the change in interest rate to a certain extent. Ladies and gents, these Greeks, they play a very important role in the life of an option trader. While gamma and Vega are the same for both call and put options, delta, theta, and rho are different for call and put options. There is a special relationship between the delta of a call option and the put option for the same underlying asset. The sum total of the delta for call and put options of the same underlying asset is equal to 1, while the delta of the call option varies between +1 and 0. That of the put option varies between 0 and -1. When the delta is +1, the option is said to be, or the call option is said to be deep in the money. And at the same time, if A is 0, it's called out of the money. Similarly, for put option, a delta of -1 puts the option deep in the money, while that of 0 puts it out of the money. When we talk about in the money and out of the money options, the whole logic comes from the intrinsic and the extrinsic values of an option. We shall talk about this definition in a later video when we start talking about the different parts of the price of an option. After having talked about the delta for call and put options and the relationship between them, we shall talk about gamma, theta, and Vega. Gamma is dependent upon the rate of change of price of the underlying asset. The higher the rate, the higher shall be the gamma. And the lower the rate of change of the underlying asset, the lower shall be the gamma. Therefore, being the second derivative, it depends upon the rate of change of the underlying, and that's how it influences the price of the option. But the other two Greeks, the first one being time, which is expressed in terms of theta, is very important to both the buyer and the seller of an option. While the buyer needs as much time to allow the price of the underlying asset to reach or cross the strike price in order to give him an advantage and in order to allow him to get a profit of the contract that he has entered, the seller of the option wants the time to decay as soon as possible so that the trade expires worthless and he gets to retain the premium that he has got from the buyer of the option. We have seen that there is a relationship between the rate of change with the change in the underlying, but the rate of change with time, it's not a straight line curve or it's not a linear relationship. If the rate of decay is slow in the beginning of the period when the contract is entered, the rate becomes extremely high when the option is about to expire. We shall see this part of the relationship between time and the price of the option when we come to the different curves that we're looking at to see the profitability of the option and the choice left for the buyer and seller of the options when they know that the trade is not going in their direction. With Vega, the option tends to get inflated as soon as the volatility of the market goes up, and the option price deflates when the volatility goes down, like what we've seen in the recent times with the declaration of the US-Iran war. The volatility peaked and it reached a value of 35 to 40, while as of now, when the ceasefire has been declared and both sides are trying to maintain their part of the bargain, the volatility of the market has dropped down to 17 or 18. This allows the traders to go on for a risk-on trade, but at the same time, the option premiums get deflated. So the last one of the Greeks that we haven't talked about so far is rho. Like we said, that it's not very frequent that the central banks or the different banks in different countries go for a change in interest rates. So the effect of interest rates may or may not affect the option premium if the interest rates remain constant or if the expectation of any change to the interest rates remains negligible. Since we do not have sufficient time on us to do the explanation for the curves relating time to option price or the price to profit and loss coming out of call and put options or a combination of the two to form different exotic financially engineered options, we shall be talking about them as well as the definition for intrinsic values, extrinsic values, in the money options, out of the money options, and various other strategies to use options as a speculation tool or a tool for hedging in our future videos. But we hope that you found our videos and our presentations informative enough and exciting enough for you to come back and watch all our videos. We shall be talking about different events taking place during the week and shall also talk about different indexes, energies, metals, and other assets which have got affected during the week because of either economic announcements or geopolitical events taking place. But until then, we would request you to please like our videos and press the bell icon underneath to subscribe to our channel Polo Vega and give us a thumbs up. You can also visit us at our website www.polovega.com or get in touch with us through our Twitter handle @PoloVega. Please trade carefully and get wealthier until we meet next. We thank you for watching our video and please like, share and subscribe to our channel Polo Vega.